Good evening, everyone. I welcome you to this conference call organized to discuss our financial results for Q3FY18. I have with me Rajiv Lal, Pawan Kaushal, and Vipin Gimani. Sunil Kakkar has joined us as a special invitee. Before we begin, I would like to state that some of the statements made in today's discussions may be forward-looking in nature and may involve risks and uncertainties. Documents relating to our financial performance have been emailed to all of you. These documents have also been posted on our corporate website. I now invite Rajiv to provide key highlights of our performance for Q3FY18 and the way forward.
Thank you, Vimal. Thank you all for being here. This has been quite an eventful quarter. What I wanted to do, however, today is just to focus on the results. Any merger-related questions, we are happy to take them. But since we just did a dedicated call on the merger 2-3 days ago, I don't want to repeat those comments or introduction. So coming to the quarterly results, I would first contextualize my comments today by saying the following. We are continue to evolve, hopefully in a more useful manner with respect to our communication to you on our quarterly results. So there are certain terms and sequences that I will use in today's presentation that may not be exactly the same as what I've used in previous quarters. But believe me, once I start doing this for the next 2-3 quarters, the clarity of the IDFC Bank's unfolding story should be greatly enhanced. And in any case, we are open to your comments and suggestions to how to further improve it. So let me start by saying that this has actually been a tremendous quarter where we have seen very significant traction on our stated strategy of continued retailization of the balance sheet, both on the asset side and on the liability side, as well as on diversification away from infrastructure in the wholesale bank towards non-infrastructure business, funded business, as well as non-funded business that contributes to our fee-based revenues. So on all these metrics, including distribution and customer base, we have made significant progress. Let me first start with customers and distribution, because that is quarter on quarter what is building momentum in our performance. At the end of this last quarter, ended December 31st, we are at 2.39 million customers, up from 1.94 million customers last quarter, as in September quarter. And you just see the trajectory of growth. Exactly a year ago, we were at 1.13 million customers. December 31st, we are at 2.39 million customers. Our customer acquisition has now accelerated from 120,000 customers a month to 150,000 customers a month. So gaining good traction. I can give you a little more granularity. Of the 2.39 million, 1.29 million, 1.3 million about, come from our BC network, which is the IDFC Bharat Limited and other BCs around that. That number is up from 1.1 million customers last quarter. So through the BC network, our customer acquisition has gone from 1.1 to 1.29 million customers. Through our Bharat branches, our customer base has gone up from 550,000 to 740,000 over the quarter. And now through our Bharat Plus network, distribution network, our customer base has gone from 280,000 to 360,000 customers as of December 31st. So that's on customers. This customer acquisition is being driven through, as I said, various channels, the branch channel, the DC channel, as well as the digital channel. But let me give you a sense for our physical distribution network and how that is scaling up. We are now up to 127 branches. We have added 27 branches over the last quarter. End of September, we were at 100 branches. This time last year, we were at 74 branches. So from 74 to 127 has been the expansion of our branch infrastructure network. By March 31st of this year, meaning end of this fiscal year, we aim to add another 23 branches so that we get to 150 branches before the end of this fiscal year. Our BC branch network is more or less stable at about 360 branches. We are not expanding that for the time being. That is really our asset lending machine in the lower customer segment. We are rather building up the branch network, the main branch network, which I just described to you. As far as our micro ATM network is concerned, that continues to grow at a healthy clip. We are now at 13,070 micro ATMs, up from 10,258 at the end of last quarter. This time last year, we were at 4,232 micro ATMs. So we have trebled our micro ATM network over the last 12 months. This is the customer and distribution network that is driving the transformation of our asset composition and growth. So let me take you through what is happening on the assets front. Our total wholesale bank, is now has assets outstanding of about 46,500 crores. Quarter on quarter, this has been flat. And why this has been flat is because our infrastructure book continues to shrink, which is a strategic decision on our part. The infrastructure book, as of end of December 31st, stands at 25,138, down about 4,000 crores from 29,000 crores and some at the end of September. So that's a 13% quarter-on-quarter shrinkage in our infrastructure book. Year-on-year, the shrinkage in the infrastructure book is about 9%. Corporate banking, ex-infrastructure, has seen a 16% quarter-on-quarter growth and a 22% year-on-year growth. So this quarter, the growth has been particularly accelerated. We ended the quarter in corporate bank ex-infrastructure assets, advances, at 21,376, up from 18,447 crores at the end of September. So that's on the wholesale part of the book. Now let me turn to retail. In the past, I've been using this term, which is direct and indirect retail. Most of you are actually interested only in the direct retail portion. The indirect retail comprise essentially our PSL buyout book. So I'm not being polite or cute anymore. I'm calling direct retail basically retail, and I'm dropping the nomenclature of indirect retail. I'm just substituting that with PSL buyouts. So our retail book, organically grown through our distribution network and our sales force, stood at 5,991 crores at the end of December, up 27% quarter on quarter from 4,733 at the end of September. This organic retail book, end of December last year, was only at 1,700 crores. It is now close to 6,000 crores. So organic retail, we are doing on average at a monthly run rate of at least 600 crores a month. This is the pace at which organic retail is growing, and I can tell you about 50% of that is in Bharat Plus and its range of products, and 50% of that roughly is in Bharat and its range of products. So that's on the our PSL buyout book, which was the indirect retail, has actually come down It's come down to 7,760 crores from 9,200 at the end of September. There's a 17% shrinkage in our PSL buyout book, which is a good sign because it shows that we are generating organically PSL through our Bharat network lending. That's on the asset side. That is the story I wanted to share with you. Provisions, quarter and quarter, no change. And I'll come back to the question of stressed assets at the very end, but the headline is no additional credit provisions this quarter. Now let me turn to the liability side of the balance sheet, which is an equally compelling story. And I want to focus your attention on two particular metrics. First and foremost is CASA. We ended December 31st, this last quarter, 33% up quarter on quarter, with a CASA of 4,254 crores, up from 3,200 crores at the end of September. Our CASA this time last year, in December, was only 900 crores. So it has almost quadrupled over the last 12 months, right? And I'll give you some more color on the nature of CASA in just a minute. Second data point on the liability side I wanted to draw your attention to is core deposits. Core deposits is CASA plus retail fixed deposits. It says something about our retail depository franchise. Core deposits stood at 7,991 crores as of December 31st, up 13% quarter on quarter from 7,043 at the end of September 17. Core deposits last year, this time, were 3,100 crores. So year on year, the growth in core deposits has been 157%. So headline message, both on the asset side and on the liability side, the pace quarter on quarter of retailization continues as we had indicated to you. Let me now give you a little more color on the nature of CASA. As I said, CASA stood at 4,254 crores at the end of last quarter. Of this, savings account were about 1,900 crores and current accounts were 2,300 crores. Now let me break up CASA in another way by the type of business that is generating that CASA. So there is the retail business that generates CASA, there is the government business that generates CASA, and there's the corporate business that generates CASA. Of the 4,254 crores that we had CASA end of December, 1,171 were pure retail CASA. Retail CASA from last quarter was up from 810 crores. So just in one quarter, retail CASA went from 810 to 1,171 crores over the quarter. Government business accounted for about 1,300 crores of the CASA as of period end. So of the 4,200 odd crores of CASA end of December, 1,300 crores come from the government business, which is a sticky business, and 1,770 crores comes from the corporate business. We are seeing real traction quarter on quarter on CASA. Okay. Couple more data points on CASA because this has a bearing on what is happening to our cost of funding, right? CASA as a share of deposits, which is the number that you guys track, end of last quarter was 8.2%. End of this quarter is 10.1%, right? This time last year, the CASA ratio, CASA divided by deposits, was 3.3%. We are now at 10.1%, okay? Just to give you quarterly increases. This is important for you to focus on. This ratio has gone from 3.3% in December 16 to 5.2% in March 17 to 6.8% in June 17 to 8.2% in September 17 to 10.1% in December 17. So solid traction on the share of CASA in total deposits. Likewise, CASA as a share of total deposits plus borrowing is now up to 4.4%. It was 0.9% this time last year. Last quarter, this ratio was 3.2%. That is, CASA as a share of deposits and total borrowings is now up to 4.4% and is beginning to have some impact on our average cost of funds. Okay. If you look at core deposits, which is CASA plus retail deposits, retail fixed deposits, as a share of our total deposits, we are now up to close to 19%. End of December, core deposits as a share of total deposits was 19%. This time last year, the same ratio was 11.5%. Core deposits as a share of total deposits and borrowing is now up to 8.3%. It was 3.3% this time last year. Okay, so much for balance sheet. Let me now turn to the profit and loss account. So let's first talk about net interest income. Net interest income for December 31st, 17 was 511 crores. Up quarter on quarter 7%, year on year up 5%. Non-interest income. Down 4%. I'm sorry. Year on year it was down 5%. Quarter on quarter, net interest income up 7%. Non-interest income. Fees and commission is the most important point, which is a part of non-interest income, which is what we've asked you to focus on. This is what we are building primarily on the back of our non-funded asset growth. Fees and commission was up 27% quarter on quarter. Sorry, 30% quarter on quarter, 27% year on year. It stood at 138 crores as of December 17, up from 106 crores in September 17. So steady traction on fees and commissions. Trading gains is where we've taken a hit this quarter, and that's because of the volatility in the markets. Our trading gains, net of mark-to-market provisions, we saw a loss of 33 crores. As of December end, and this obviously is a one-off event, and which is what is dragging our overall performance on non-interest income. Profits after tax. So I wanted to give you a sense of what is driving profits after tax. So profits after tax stood at 146 crores for the quarter ended December. They were down 37% quarter on quarter. They were down 24% year on year. But the major driver for this decline in the profits after tax line is actually trading gains, which turned into losses this last quarter. The second contributing factor to the decline in our profits after tax is our investment in our network and people. So if you look at our non-HR operating expenses, they were up 33% year on year, 18% quarter on quarter, which is a reflection of the accelerated pace of our network expansion across the board. So two reasons why our profits after tax are down. One is investment in building out our retail network at an accelerated pace, and second, one-off trading losses in this quarter. Okay, a little more color on the P&L. So I wanted to give you a sense for our asset yields and again flesh out the story of our retailization. So the average asset yield in our wholesale book, wholesale lending, which comprises infrastructure and ex-infrastructure corporate banking, was 9.55% end of last quarter. Asset yield was 9.55%, is declined somewhat from the first quarter of this year. And the first quarter of this year it was 9.68. So over the 3 quarters of this financial year, we have seen a slight decline along with the market and competitive pressures, etc., in the asset yield on our wholesale book. Retail book, our asset yield at end of quarter 3 stood at 12.47. That too has drifted down a little bit, but the important point is that the retail asset yield average is about 300 basis points higher than our wholesale banking asset yield, and therefore the faster we retailize the balance sheet, the better outcomes we will get on our NII on a blended basis. That's for the asset yields. Now let me give you a sense for the cost of funds. Our average cost of funds has come down from 7.38 at the end of Q1 of this year to 7.23 at the end of the last quarter. And one of the primary driving forces for this decline in the cost of funds is actually the changing composition of our liabilities and at the margin, the rapidly rising share of CASA as a share of our total deposits and borrowings. So a decline in our cost of funds, also a slight decline in our asset yield, but net, a rise in our net interest income. Next thing I want to focus on, I've talked to you about asset yields, I've talked to you about cost of funds, I've talked to you about the general P&L. Now I wanted to shine the light on a more granular light on another important aspect of our P&L, and that is on fees, which is what we are very focused on. So fees and commission, as I had shared with you earlier, quarter on quarter we saw a growth of 30%, year on year 27%. And particularly if you look at our fees coming from trade and cash management, this saw a quarter on quarter growth of 5%, a year on year growth of 75%. At the end of quarter 3, trade and cash management related fees stood at 33 crores out of the total fees and commission of 138 crores. Investment banking and syndication fees have done particularly well for us. They tend to be a little more volatile, admittedly, but it's been a very good year for investment banking and syndication. The fees contributed by this line item end of quarter 3 was close to 43 crores, up from 18 crores at the end of last quarter. Final point I wanted to make is what is the driver for the trade and cash management fees, which are seeing steady quarter on quarter growth and therefore a rising contribution to our fees and commission line item on a quarterly basis. It's the growth in our non-funded exposure. Non-funded exposure, trade related, stood at 27,258 crores at the end of December 2017, up from 25,000 crores sum in the previous quarter, and up from 14,000 crores 700 from this time last year. Point I'm making is that we continue to drive quarter on quarter the development of the non-fund business that is contributing to an improving quality of our fees and commission line item in the P&L. Finally, let's talk about asset quality. So you will have seen our credit provisions grow this quarter. Credit provisions went from
Provisions on the NPA went.
Sorry, not provisions. That's very important. Our NPAs went up from what is the number?
1990.
Yeah, sorry. I'm finding it difficult on this new chart. NPAs went up quarter on quarter from 1,990 to 2766, correct? 1990 to 2766. But important point is there was no hit to P&L. There was no additional provisioning taken on account of these NPAs. I wanted to spend a minute explaining that. You will recall, I'm going back into some context, that we had some 9,000 odd crores in terms of stressed assets, of which we sold 4,000 crores to an ARC, against which we got 2,000 crores in SRs. So including SRs, what you currently see at the end of quarter on our book as stressed assets, including 2,760 crores of NPAs, is a total of 7,314 in stressed assets. This includes SRs of about 2,000 crores. So if I strip out those 2,000 crores, I'm left with 5,300 odd crores of stressed assets, against which I have a provision cover of 3,495, right? So even if of this 5,300 crores, some additional assets are reclassified from identified to NPA, the provisioning cover against these assets is not declining, right? It will remain at 60%, and hence we are signaling very strongly to you that our stressed asset situation overall has not changed at all. It is as we have advertised to date. I think I've covered all the points I wanted to touch on. If there are any questions, I'm very happy to take them in Q&A.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. First question is from the line of Manish from Nirmal Bang. Please go ahead.
My question on the your retail book, can you give some color in terms of segments or product segments where we are growing such as fast pace? And secondly, on a cost of deposit side, what is the average cost of deposit in the quarter 4?
Yeah, excuse me. So on the asset side, as I said, of the 6,000 crores of retail assets outstanding, roughly half is Bharat Banking. So it is JLG and associated products. And the other half is a range of housing loans and personal loans, secured and unsecured. On the cost of deposits, just give me a second. There is a slide here. Here it is. The cost of deposits, cost of core deposits at the end of average cost of core deposits in the last quarter is 5.63%.
Okay. And second question on the kind of investment we are making on distribution side and branch expansion. So over the medium term, you said 25 branches you will be adding in this quarter. So over the medium term, what kind of size we envisage? Because now the digital thing, many of the large banks are also cutting their long-term branch expansion targets, and now physical branches are more, less relevant in a current parlance. So what is your realistic target for the IDFC Bank in terms of branch network for over the next 2 to 3 years?
So we said we'll be up to 300 branches over the next couple of years. So we will double our branch network from 150 to 300. You have to understand that the branch format is very different from a traditional branch format. Ours is much lower. Is a lower cost branch format, and over the next quarters we will be happy to share more about branch economics as that data begins to mature.
And last one request to you and the management team of IDFC Bank, please put the presentation for the merger, because what is the timeline timeline of each phase of approval, it is very relevant for us.
Sorry? So when you say the presentation of the merger, what do you mean?
Generally the M&A transaction presentation posted by the listed companies. So
we will do that.
So the timeline, just in case you were asking for, as I said, it's a sequence of events, but most likely we are targeting around
November 2018.
But it will be effective from April 1, right, sir?
Sorry?
It will be effective from April 1st, 2018.
Yes. Effective date. Appointed date, as they call in the scheme of arrangement, as more for consolidation purposes, will be effective.
Yes, correct.
1/4/2018.
So if we get approval in October 2018, we will be restate our numbers, right?
Yes.
Okay, sir. Thank you.
Thank you. A reminder to our participants, anyone who wishes to ask a question at this time, they may please press star and 1. We have the next question from the line of Naveen Vaid from Aditya Birla Money. Please go ahead.
If I understand you correctly, sir, you said that the overall stressed pool has not changed. So what was 9,000 crore in the previous quarter, about 9,000 crore, is 9,000 crore this year. So if I understand and get the numbers correct, there has been around fresh slippage from within the stressed pool to gross NPA of about 800 crores. Is that correct?
That is correct, but with no increase in provisions.
Okay.
So this is a pure asset classification thing, and this is an important point because we have been ahead of the curve in taking provisions against assets in our judgment that we felt were stressed, irrespective of their classification.
Got that, sir. And so out of this 800 crores, is there a lumpy account or this is broad-based in terms of slippage?
So it's no lumpy accounts. There are several accounts which have been reclassified to NPAs.
Okay. Thank you, sir. That explains my question. Thank you.
Thank you. We have the next question from the line of Amit Rane from Quantum Securities. Please go ahead.
Hello. Yeah, thank you for the opportunity. So last quarter you had given a number that 2,000 crore is the net stress asset number, right? So where do we stand today?
Same. Exactly the same.
It is the same. And your outlook going forward on this number?
So outlook, that depends. We've had this conversation before. It really depends on NCLT and how all that plays out. We have taken the view that we have made sufficient provision, but if the NCLT process becomes dysfunctional, then we will revisit it.
Sure. Thank you.
But to give you a sense of the overall number, this is it.
Okay. Thank you, sir.
Thank you. We have the next question from the line of Rahul Agarwal from Stewart and Mackish. Please go ahead.
Hello, sir. My question to you is, what is the reason behind such a exponential rise in your quarter-on-quarter growth of provisions?
Sorry?
109%.
I didn't understand it. Could you please repeat the question?
Sir, in page number 6 of your investor presentation, your provisions and contingencies have increased from 27 crores to 109 crores.
Yeah.
That is a 309% rise on a quarter-on-quarter basis.
That is almost entirely due to trading. It's all due to trading losses.
So it's a mark-to-market.
It's a mark-to-market.
It's not a realized.
It's not a realized loss.
So as of 31st of December, when we had to revalue our AFS book, this is the amount of mark-to-market we have had to take into the accounting books.
And thank you, sir. And my next question is, sir, since you have increased your expenditure on non-HR and HR, what is the time period which I can expect that this will be recovered, as in the retail business will grow by bringing an impact of this expenditure?
No, so it depends on the branch format. It goes from anywhere from 18 months to 30 months.
Okay. So it's an 18-month period which I can expect.
Yeah, so it will be a mixture. So call it, I don't want to give you a number, but between 18 and 30 months.
Okay. Thank you, sir.
Thank you. Anyone who wishes to ask a question at this time, they may please press star and 1. We have the next question from the line of Sneha from Shubhkam Ventures. Please go ahead.
Sir, my question is on this wholesale book that we can see again declining by the same trend what we have seen in the current quarter, and how the retail growth would be picking up in the same trend.
So I've explained that the wholesale book has declined deliberately because we shrunk the infrastructure book. But so the non-infrastructure wholesale book has been growing extremely rapidly. Quarter on quarter, it's grown 16%. The retail book likewise is grown very, very aggressively. As I said, we are growing quarter on quarter 27%. We have a run rate on retail assets of over 600 crores a month, and I aim to accelerate that run rate.
Okay. And one more question on the fee income side, which has grown deliberately very strong on this trend of the 30% quarter on quarter. Can we see this higher trend continuing on quarter basis of 30%?
So on the fee-based income, if you're looking at us on a medium-term basis, meaning over the next 2-3 years, you have to track the share of fee-based income that comes from cash management and trade, because that the two and second one is the loan-related fees. These are the two that are stable, right? Investment banking, it's been a very good year, but it is a volatile business. So I have 138 crores of fees. It's grown very nicely. But what I'm really focused on is growing the 33 crores of fees that come from trade and cash management. I want that to double over the next 12 months, if not more.
Okay. My next question is on this cost to income ratio, which currently stands at 57. We are planning to expand by branches around 300. So where do you see a sustainable cost to income ratio down the line by FY20?
Look, FY20 is still early. We have to wait 24 months for us to continue investing. But I can tell you this, that the format that we are using, and this will become clearer to you in time, our cost to income ratio will be better than best in class retail banks in the country.
Okay. And my last question is just wanted to clarification that you on the stress book, you are mentioning that SRs are standing around 2,000 crores, right?
Correct.
And how much provision we are holding on that?
That is 50%. No, so wait a minute. The total book that was sold was 4,000 crores, against which we got 2,000 crores in SRs. We have another 333 crores of provisions against this 2,000 crores.
So net is 1,700.
So net actually is 1,700 crores.
Okay.
And we believe that we will not need to take any more provisions against this. That's our belief.
Okay, got it. And anything on the NCLT we are holding, any stress, and how much provision we are holding on that?
Sorry?
Any account we are holding on the NCLT, and how much is the provision we are holding on that?
We have 4 accounts. We have a few accounts in NCLT, and all of them are adequately provided, above 50% on all of them.
Can you share the amount, if you don't mind, on the NCLT?
I don't think we can do that. Let me just, can we?
We haven't discussed whether we want to share that. Bear with us 1 quarter. Stay with the headline signaling that we're giving you, is that against the 7,300 crores, we have 60% provision coverage, and we believe that is pretty solid. Okay?
We are more than adequately covered on the NCLT accounts.
Yeah. And last is, how do you see the outlook on the margins, and could you guide us?
So the outlook on the margins, we are hoping to play the game that we have played over the last couple of quarters, is that as we quarter on quarter improve our funding mix, right, and we replace our higher cost liabilities with lower cost CASA, we will be able to better withstand the downward pressure on asset yields on the corporate book. A. B. As we continue to retailize aggressively on the asset side of the book, we will be able to improve our average asset yield on the overall balance sheet as well. So I would like to say that we are going to be, we want to be constructive on our NIMs. That's our view. That at the pace we are going, we should be able to protect our NIMs at the very least.
Okay, got it. Thank you, and all the best.
Thank you.
Thank you. Okay, the next question from the line of Harshit Shah as an individual investor. Please go ahead.
Congratulations for the result. There are a couple of questions. One is, when do we plan to add all the functionalities in the accounts? I mean to say, demat and trading and tax payments. These are the basic functionalities which are not yet available.
Yes. So there are 2 functionalities that are going to come up over the next month. One is there's an NRI facility that will become, which is in testing as we speak. Over the next 6 or 7 weeks, I think it'll become available. That's one. Second is, on the demat, we have just cut a deal with another provider who is going to be providing on our behalf of our customers, demat facilities. That will go live. I don't know the exact date off the top of my head, but we are expecting it that before the end of this fiscal year, it will also go live.
Okay. And for the tax payments?
Sorry?
Tax payments, GST and all this income tax payments.
So what about it?
We have not been getting that.
We are not empaneled yet.
We are not empaneled yet.
That still, I'm afraid, continues to be irritant. I don't have a better answer for you as of this point. But I should tell you separately that, and we didn't present you the details on that. But our wealth management fee income is gaining very rapid traction. And we can, share with you, certainly next time I will share with you the AUMs on the wealth management and the fee-based income associated with that is developing.
And sir, the last question is, how much time, we are opening many branches, and how much time does it take to break even for the, in general, the branches?
So 18 to 30 months depending upon the format. But I aim to bring these numbers down. Today it's 18 to 30 months, but I want to bring these down to, 14 months, 24 months. So that's a work in progress. But right now we are doing 18 to 30 months.
Okay, sir. Thank you so much.
Thank you. A reminder to our participants, anyone who wishes to ask a question at this time, they may please press star and 1. We have the next question from the line of Aditya Singhania from Enam Holdings. Please go ahead.
Thank you. I just wanted to clarify the asset yield that you spoke about, the wholesale banking asset yield at 9.55. This is the entire wholesale bank, including the credit substitutes?
Yes, this is the entire wholesale bank, including the credit substitutes, but excluding the stressed assets.
Okay, excluding the stressed assets.
Yes.
Right. And, could you just remind us what is the accounting for the stress book that you've sold the SRs? Are you recognizing any income yet on that?
No, all our collections under the SR first go down to pay the principal.
Okay. So has there been any pay down of principal yet?
Yes, we have. We received two installments so far.
Right. Okay. And the long-term bonds that you have, which you have been mentioning, is causing a drag on your margins.
Yes.
Could you clarify what is the timeline when it sort of starts to run out?
So that cost of that is 8.9%. It starts running off FY21.
Sorry, it starts running off FY21.
No, Sunil, just clarify, no?
Yeah, so let's say almost 50% of that should come down by FY21, and the tail. So by the time it's about 50% for the first within the next 3 years. Correct.
Okay, got it. And the fees breakup that you shared, there was cash management 3 crores, investment banking and syndication of 43 crores. Could you clarify what the rest of it was?
Just give me a second.
Loan-related fees.
Loan-related fees.
So that's wholesale or retail?
It's both.
Would it be possible to split fees by retail and wholesale as well?
Let's not. We don't have to split hairs here.
Okay. All right. Thank you.
Okay.
Thank you. We have the next question from the line of Jay Mundra from B&K Securities. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. Sir, just a couple of things on the. Can you give I missed it if in case you have provided the breakup of the provisioning for this quarter, sir?
Yes, here.
This quarter, we see a provisioning 8 crores. All of it is mark-to-market losses because of the yields which have gone up.
Okay, so entirely is on AFS portfolio, right? Hello?
Yes.
Yeah, sure. And sir, if you can also provide the movement of NPA, how much was the slippages and the reduction write-off?
So 800 crores roughly from 19 something to 2777 was the gross NPA movement, and almost 400 crores of provisions came with it. So that's the number.
So the point being again that the PCR relative to the NPAs outstanding remains pretty much the same as the PCR that we have against the 5,000 odd crores of stressed assets excluding the SRs. You understand what I'm saying?
Correct.
Okay.
Got that. And so just lastly, post this, let's say on a consolidated entity, what would be the future of, let's say, our non-lending business such as AMC and broking business, if I may ask? Or is there any, would it be too early to ask?
That is a question for the IDFC Ltd conference call.
Sure. Sorry, is that? Sure. Thank you, sir. Thank you so much.
Thank you. We have the next question from the line of Aditya Shah from Vikram Advisors Services. Please go ahead.
Sir, I have a question about the net interest income. As explained by you previously, that the major reason for the drag is the high cost infra bonds. But what I see, sir, is that that was the case even like last year as well. But why is there a reduction even from the last year by 5% quarter on quarter and 8% for 9 months?
So two reasons I would say that as assets are getting repriced. From the asset yield perspective, if you will look at for the wholesale assets, they are sitting at a lower yield. And the other is the SR book which we sold off. Remember, Mr. Kaushal mentioned that whatever income is now coming is first going to offset the principal, and the income is not recognized. So to that extent, and of course the PSL quantum is much more this year. Last year on an average we started from 0, ended at 40. On an average we are keeping 18,000 odd crores of PSL as compared to an average of 8 to 9,000. So that kind of gives you the variance analysis.
Okay, and regarding that further, then what is the realistic NIMs that we can expect going forward, let's say on a year or 2 year basis, where how much NIMs should we expect in terms of what, let's say this quarter it was 500 crores. So going forward, do you expect yourself to go to 600, 700 crores in the next coming years, or not much?
So I expect our NIMs to improve at the pace at which we are able to substitute our high cost liabilities with CASA. So there are two things that are going to happen over the next 24 months. Is that the legacy liabilities will start falling away, right? That's one thing that will be very constructive for our NIMs. Second thing that will happen is that the share of CASA in overall liabilities is going to rise, and it's rising at a very rapid pace quarter on quarter. Both those things should be more than enough. And third thing, this is happening on the cost of fund side. On the asset side, average asset yield will improve as the share of retail assets in total assets continues to rise. So net our NIM should improve. How much they improve, I can't predict, but they should improve. We are definitely expecting them to improve.
Okay, so it won't be like this year when we are seeing a reduction. So going forward, we won't see a reduction as compared to year on year. That is what I'm expecting.
It will not be the case.
All right. Okay. Thank you.
Thank you. We have the next question from the line of Alpesh Mehta from Motilal Oswal Securities. Please go ahead.
Hi, good evening. The first question is regarding your trading book. At the time of transition, we were holding higher amount of investments since we wanted to keep higher liquidity. But now, what's the outlook? Because the size continues to remain quite high. It's almost at around 27,000 crores, and I believe it would be a negative carry on the balance sheet, ex of trading gains.
So that 26,000 crores has two components. One component is the SLR, which we...
No, this is ex of SLR, if I'm not wrong.
So what you're seeing, okay, so let me explain. So what you're seeing in the investment book is actually two other things. One is the credit substitutes, which gets reported there. So the credit substitute book has been steadily growing. They are not govies, they are corporate bonds. The other thing you see in that book is the PTCs you are buying on PSL, which also get parked as investments.
So both of those should shrink, right? Yes. We did credit substitutes instead of loans to avoid PSL, right? But we took a calculated risk on their mark to market. That's why we were doing credit substitute instead of funded business, regular advances, right? Second thing is the PSL buyout contribute to this. Both of these over time will begin to shrink. So the investment book as you see it will shrink.
In addition to that, we have this trading investments, and you're right, that number is about 26,600. But your conclusion that it is having a negative carry is not appropriate. Okay? So we will never run a negative carry book any forward, but directionally, if you will see, quarter on quarter, this has already declined by 3,000 odd crores, and it will slowly decline depending on what our view is, but we do not do any negative carry trades.
So what would be the yield on this book, only a trading investments book on our balance sheet right now?
Yeah, we repo it and borrow in the markets against this, and we make something like 20 basis points to 30 basis points on that. But I can get you the exact yield on the average duration. If you can just get in touch with Bimal, we'll give you the answer.
Sure. And secondly, when you transfer from the stress pool, you transfer some accounts to NPA and make the provisions from that stress pool that you had done at the time of transition. What is the tax treatment related to this?
Neutral. No tax implication.
So do you have any reversal, deferred tax asset reversal, something like that at the time in the P&L?
No, because
the transaction happened through net worth at that time, that's why.
No, it was not done through net worth. It was done through profit and loss. And
yeah, it was through profit and loss. Sorry, I'm sorry. Yeah. Okay, so there is no reversal on this, right? Hello?
No.
Okay. Sure. And there are no profit on sale of HTM securities in this quarter?
No.
Okay. Thank you so much. All the best.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to the management for their closing comments. Thank you, and over to you.
Thank you. It's been a tiring week. What can I say? But it's been a satisfying week. We hope to continue. We expect to continue delivering at this pace over the next quarter, even as we navigate the merger formalities. So thank you for being with us. We'll talk to you again next quarter.
Thank you very much. Ladies and gentlemen, on behalf of IDFC Bank Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.